Good morning, everyone. It is 6 a.m., half an hour before the market is going to open on Wednesday, May 1st, beginning of the month. Normally, the beginning of a month might see some increased activity from portfolio rebalancing. We might see it's not a quarter end and it's not at the end of a week, though, so we don't have things like options expiration. So we would get normal amounts of volatility because of month end, but then we have an FOMC announcement, which the markets tend to get super quiet right before because we need to hear what Powell is going to say. If he changes the language that in his speeches, and if he gives us any clues as to what is going to happen with rates. So normally volatility will decrease because of that, but then we have a ton of earnings. We had a big major earnings last night. We had continued into this morning, and then later after the market today and tomorrow morning, we have a whole bunch of reports, earnings reports as well. So that's a really big mixed bag. We are probably going to still be somewhat muted in the morning after we react to all of the earnings that already happened. But in terms of portfolio rebalancing and the activities that we normally would see at the beginning of the month, those are going to wait at least until 11:30 today before they really pick up, which means we might get a really active close because not only are we dealing with the reaction to the FOMC, we also have to take into account that portfolio managers might start rebalancing as soon as that volatility right after Powell's speeches starts to die down. So you get volatility from 11:30 to about 12:30, and then you get volatility because we're trying to rebalance in the last half hour before the market closes, which is normally a really active time period anyways. So we could see some pretty interesting stuff today. Let's see how we're reacting to the news or the earnings reports overnight. We'll take a look at our futures. We've got S&P 500 down about 25 basis points. That's a quarter. And the NASDAQ down about 40 basis points. And then the Dow down about 10, just a little over 10. So mostly random. NASDAQ a little bit more than the others. Normally we would call that at the edge of non-random or slightly significant, but given everything that's going on right now with all the earnings, we had AMD report. So this, I'm just going to call that random. So negative bias to the downside, but mostly random. So we can't read too much into it. Let's see what our pre-market looks like. We've got, after market, we traded way down. We had a slew of earnings, and the immediate response in the overall index was to come down. It looks like we were lower, definitely lower earlier this morning. And then what is this 530? Yeah, right at 530, we got a little bit of a spike. Not much, but we did see upward movement, and then that level sustain itself. So let's see if anything happened at 530. Interesting. Not really. Just a bunch of bond announcements, which on an FOMC announcement day really shouldn't do much. So well, let's see what types of earnings we had this morning, or actually yesterday after market. We went over this in the post-market session yesterday, the recorded session. So I'm not going to dig too deep into this, but Amazon, AMD, Starbucks, Mondelez, those are all big, large cap stocks that reported yesterday, and Starbucks was down, AMD was down, Amazon, I believe, was up after the announcement. Yeah, so their pre-market is way up here. And it's interesting because what we want to do is start to get a feel for how retail is doing and how consumers are spending their money. Yesterday, we had the consumer confidence report. It was much lower than expected. So if the consumer is losing confidence, then the economy is losing heat, and there's going to be less support in the markets. The fact that Amazon did well is encouraging, but then Starbucks was way down, if I remember correctly. Starbucks is way, 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 way down here. That's crazy. It's down about, what is that, 9, 10, 11, 12, almost 11, a little over 11 on, it was 88, so 1/8, so about 12.5%. So that is quite a bit for Starbucks to drop, which means they're not the consumer. If people aren't going to spend $4 or $5 on a cup of coffee if they're not feeling good about their personal economy, they'll switch to drip coffee or making coffee at home or whatever it is. So that is not a good sign for the consumer and the overall economy. And that gives me more confidence that our S&P 500 could hit that 10% correction. Let's see what else. Let's take a quick look at AMD. AMD down, not as huge as Starbucks, but they're down because they said they had positive earnings, but they said that it was about their AI. Oh, AI wasn't doing as well, or they had a slowdown in their AI business, which people don't like to hear about AI. So that is also not great news. Let's look at this morning. I'm really curious to see if earnings is what caused that 530 dip, or not dip, boost. Today, before market cap, we have MasterCard, Pfizer, ADP, CVS, KKR, Marriott. Marriott is going to be another one that indicates consumer confidence, and Estee Lauder as well. Let's take a look at those two. Marriott down, EL down. Okay, so the consumer is not too happy right now, which is not great for the medium term in the markets. Also the economy, but we care about the markets. CVS, ADP, Pfizer, CVS, way down. ADP, up. Pfizer, up. And then we had a MasterCard, down. Also not great for the consumer if people are not willing to use their credit cards. So I don't see anything that would indicate a boost in at that 530. So it could be the bond auctions. Maybe they went really well and they're at a lower rate. Let's look at TLT. No, well, TLT is not really moving. So we'll just chalk it up to another, just like yesterday. We don't care too much why, we just care that it happened. And it wasn't a really huge move anyways. It's just this tiny, tiny baby move upwards and then a chop sideways. And so it just looks like we're going to be in between these major lines that we have on the chart, 500 being very significant in terms of support. And let's see where our MA90 is right now, 498.87. So we'll just call that 499. So that 499 to 500 region is going to be important level today. If we break that, then we're going down. We're going down, and there's no real support until this purple line right here. Now, I guess there's a tiny bit of support at 490. So let me pop in a line right there, 490. Yep, a thin line is appropriate. So we may get a little bit of support at 490 or a little bit of a pause at 490. And then if we break that, then we'll hit this 475 level, or most likely. We might just get close to it, but 5 region. We have the MA 150 now a little bit above that 475 region. So it could be near the MA 150 as well. Okay, so we're really going to want to see to the downside. That's the one that we're going to watch more carefully. Of course, if it goes up, then we have all the levels, all the same levels we've been looking at, the 505 and 510 being the main ones, and then this 502 and a half. I'll just make this a thinner pixel, and the same with the 508 and a half. Okay, let's save those. So today, I'm not going to expect a lot of market directionality going into the FOMC announcement. If we could, because we had so much earnings, but even so, that FOMC press conference, the things that Powell says are going to be very important. And if I was still a money manager and I had billions of dollars to deploy, then I wouldn't be doing anything in the morning. I would definitely be waiting until Powell starts talking. So I don't expect a lot of movement in the morning, although it could move. If it does move, then we want to see if there's a volume behind it, but most likely there's not going to be a huge amount of volume behind it because most of that powder is going to be kept dry for when Powell starts speaking. We are technically moving downwards. We expect to come down and hit that 500 and MA90 region based on the daily chart. So it's a pretty high likelihood that we will come down and touch this level, at least at some point today. And then we'll see if we break down through it, if today's the day that we break down through it. Right now, we have a higher probability of us coming down and breaking through than we do of coming down and bouncing up, and certainly higher than for us to just move up from where we are. And we are definitely more likely to break the MA90 at this point than we are the MA50, which is the same case as a couple of days ago. It's just that the probabilities are a lot higher now. We were saying the same thing when we came up near that MA50. We were saying that most likely direction is downward, and we did start to move downward. And now our higher probability event is a break of that MA90, especially given all of that consumer sentiment data that we just got, the actual consumer sentiment report, then the earnings on consumer discretionary items like Starbucks, McDonald's was way down a few days ago. Right, McDonald's, it did recover a lot, but it gapped down. So normally, what did it do? It traded down and it gapped way down. It traded right back up to the EMA 8, EMA 20 region. So traded right back up to resistance. And what do we normally expect from that? If we get a downward movement and a retrace, we expect a resumption of movement in the original direction. So the expectation right now is to continue to move downwards unless it can break through that resistance with conviction. Starbucks, we had AMD, we had I don't remember. There was a couple others that we said were indicators of the consumer sentiment. I could look, but I don't want to especially MasterCard. MasterCard was a big one. If people are not using their credit cards, then that is a huge indication that the consumer has either run out of buying power, which means they want to spend, but they can't, which is basically the same, or it puts you in a similar situation as they just don't want to spend. They just don't want to spend is obviously a worse situation in the short term, but in the longer term, the inability to spend is a little bit more disconcerting because either they not deemed credit worthy, which means that their ability to spend in the future is way down, or they've maxed out their credit cards, which means not only is their ability to spend in the future way down, but now they have a huge debt that they have to service. And either that money is going to service the debt and not going into stimulating the economy, or they're going to default on it and the credit card companies are going to take a big hit. So either way, no matter what, doesn't matter why, where we are is just degrees of indication of how poorly the consumer is doing. So not optimistic news for the overall markets, at least in the short term, which means almost guaranteed we're going to come down and hit this MA90, and a pretty strong guarantee that we're going to move downwards from there. So let's take a look at our sectors. So if that's what we're expecting, what sectors would do poorly? Well, we talked about in the weekly market review on Sunday how XLV, no matter what situation, we didn't really expect it to go up. At best, it could chop sideways. At worst, it will move down. And you can see that we've mostly chopped sideways so far. And after the CVS earnings this morning, it looks like we're starting to tend towards the bottom, tends towards moving downwards. Let's look at other major ones in the healthcare. So yeah, J&J, I'll pop way back up. Yesterday traded way down. Looks like after for whatever reason, it's gapping at the EMA 20. I don't know how reliable that is. Sometimes we get very sporadic data. So let's take a look and make sure we're not, oops. We have decent data. Okay, so some sort of news, but we'll see. We'll have to see how that trades. In any case, the point was that there's a lot of healthcare stocks that are just chopping sideways or may move downwards. That's a little bit of a safer place to put our money right now. But again, with FOMC, we don't really want to take big bets. What is clear, though, is that we're probably going to go into more defensive sectors. We saw that yesterday, I believe. Make sure I'm not confusing my days, where we had movement into defensive sectors. Healthcare, staples, utilities, financials. Yeah. Safer sectors, medium risk sector. Well, these are the safest sectors we have. So money is definitely moving into more defensive sectors. That is overall bearish, which means that people don't want to take risk, or money managers don't want to take risk. They want to put their money in somewhere a little bit safer that's not going into to tech. It's not going into semiconductors. It's not going into retail. It's going into very steady sectors. So that is another indication that we're probably going to move downwards. And then let's look at our VIX. Yeah, our VIX is starting to move up. We're at 16 right now. And yesterday we identified about 15 and a half. If we started to move above 15 and a half, that's not really great news. So right now, if we believe that we are moving downwards and then the VIX is going to spike upwards, volatility is going to move upwards. When volatility moves upwards, people call it the fear index, but professionals don't. Professionals look at volatility as opportunity, because when volatility means prices move in large amounts in short time periods, that's opportunity. That means that if prices can move in a short period of time, that means that if you do your analysis well and you pick your stocks well, then your asset price will move very quickly, which means you can make a lot of money in a short time span. So this is an opportunity. What will happen is when you have periods like this, when volatility is low and steady, then you take a more of a portfolio approach and you're looking for slow and steady growth in your portfolio. And then when volatility spikes, you have to move off of, it's too much to explain this early in the morning. but so when volatility spikes, you want to switch to the shorter term strategies and catch those fast opportunities. And then when it comes back down, then you widen out again. So in terms of what we do over here, what that means is in this environment, as we move higher, then we're looking at 1 day trades, 2 day trades, 3 day trades. And then when it comes back down, then we're looking at 5-day, 10-day, or 15-day trades. Okay. Day, 5, 10-day, meaning trading days, not actual calendar days. So a 5-day trade would be a 1 week. So 1, 2, or 3, maybe even 4-week trades when volatility is low. And when volatility looks like it's going to spike up, we start switching to 1, 2, and 3-day trades or day trades, but we don't day trade over here. So that means we're going to start expecting to have a rapid pace of putting on trades and taking them off coming up, because we do believe that volatility is going to spike. Why? Because we see the S&P 500 creeping towards the MA90 and a higher probability of it breaking down. So that's the way to think about the structure of our trades and our portfolios. So we're not going to expect too much movement, although with all the earnings, there's definitely going to be movement, but we're not going to expect too much movement or directionality before 11:30. 11:30 is all the way over here. So we're going to wait most of the morning. We're going to watch very carefully to see how the market reacts to this 500, 499 level region, which is pretty wide on the day chart right here. And if we break through that, then there's probably going to be no recovery. It's probably just going to keep on slipping down. And if we break to the upside, then 505 and 510 are going to provide important resistance. And again, we're probably not going to move beyond this 50 or maybe even the 502 and a quarter, even though it's really close to where we are right now. But just to be a little bit more safe and conservative, we're probably not going to move outside of this 505, 500, or 499 region until we get to the FOMC press conference. So if we see this moving upwards, well, that's normal because we have a little bit of a gap down from where we closed, and we normally move in the direction of the previous close. Just like on this day, yesterday, we initially moved in the direction of the previous day close before we broke down. So today, in the direction of the previous day close, and then we'll probably float around all day until the press conference and then pick a direction. But we'll leave that there. We have a good roadmap of what we expect during the day. Of course, if anything breaks that expectation, then and you're available to react during the day, then that's opportunity. If anything breaks the normal expectation, that presents an opportunity. So if you can, or if you want to, then you can watch for those opportunities throughout the day. But for the most part, most likely any opportunity that happens is going to be after 11:30. All right, guys, have a wonderful rest of your morning. Watch out for the FOMC announcement, and then I will see you in the post-market session.